Life insurance. Why you need and how to choose. Even if you are not a stuntman, do not go in for extreme sports and do not risk your head daily. Take a closer look at life insurance programs. With life insurance, you can save up for planned expenses like a wedding or a down payment on a mortgage, or secure an increase in your pension. What are the benefits of life insurance? In addition to the original goal of providing an airbag for loved ones in case something happens to you, life insurance has other options. Save up for planned expenses, for example, for teaching children at a university. Save up for an increase in your pension. How to choose an insurance program. Insurance programs are different. 4 types can be distinguished. Risk insurance. In its purest form, risk life insurance implies a single insured event, death. In this case, the insured makes one installment or pays them regularly. It all depends on the contract. When an insured event occurs, his relatives receive the money. Risk life insurance often becomes the basis for so-called mixed insurance, in which you receive a payout even if you become ill or injured. There are no savings made. In such mixed insurance, you can independently choose amount of payment, a list of possible adverse events, term from 1 year to 20 and more years. The amount of contributions is calculated by the representative of the insurance company. It depends on the company's tariffs and other factors. Example, Oliver works as a driver and pays off the mortgage. Last weekend, he slipped, fell, closed fracture, passed out, woke up, cast. Now he won't be able to work for a while. But Oliver has an insurance policy. The insurance company will pay him an amount that will support Oliver's family while he recovers from his injury. Another special case of risk insurance is credit insurance. In this case, if the bank is listed as the beneficiary, the payment will be received not by you, but by the bank where you took the loan. If something happens to you, your family will not have to pay for you. Risks covered by accumulative life insurance programs. Survival until a certain period. Death. Death as a result of an accident. Disability. Endowment insurance. A combination of insurance and savings. Classic endowment insurance has a fixed income, true, and the possible income will be lower than with investment insurance. Once you have entered into a contract, you may have both options or one of two. An insured event has occurred, your beneficiaries will receive a payment. Nothing happened to you before the end of the contract. You receive your savings. Example, Tony and Jennifer have a son. Parents are sure that they will give him an apartment for adulthood. Tony pays annual premiums to the insurance company. And on his son's 18th birthday, his parents will give him a certificate. At the same time, Tony's life is insured for all 18 years. If an accident happens, the insurance company will pay the accumulated amount by the date specified in the contract. That is, you can save money for something important for 10 years, and all this time your life will be insured. You can choose the amount of contributions and payments yourself. The term is from 5 to 20 or more years. It is possible to conclude an agreement for a shorter period than 5 years. But in this case, the profitability will be low, and the tariffs, on the contrary, will be high. Tariffs for endowment life insurance vary within 4–10% of the sum insured and depend on age, gender, as well as the set of risks in the insurance program. Let's look at the main schemes for the movement of the money of the insured in the context of various insurance programs depending on the sales channels for life insurance products. Endowment life insurance and a bank deposit are incomparable investment instruments, but they are designed to complement each other. Voluntary pension insurance. The program of voluntary pension insurance is similar to accumulative insurance. The first difference is that the major event is retirement age, and the second is that you can choose the period during which you will receive an additional pension. Everything else is the same. You choose the size of your pension and pay regular contributions. Example, John decided that his pension would not be enough. For the past 20 years, he has paid contributions to the pension insurance program. After retirement, John will receive additional payments for life. Pension insurance options. Lifetime pension. You choose the period from which you will start receiving additional pension. If something happens to you, then the accumulated balance of the pension will not burn out, but will be paid to the beneficiary, the one you appoint: husband, wife, or other close relative. Term pension. You specify a specific period when you want to receive an additional pension. What additional conditions of pension insurance can be? You may be exempted from contributions if you become disabled. In this case, additional monthly payments may be assigned. Accident insurance. Additional conditions are not provided by default, but must be specified in the contract separately. Investment insurance. In this case, you let the insurance company manage your money. The savings are divided into two parts. The guarantee part will ensure the return of your money if the situation on the stock market is unfavorable. The investment part can provide additional income. Not all capital generated by your contributions can be protected from an unfavorable market situation. So read the terms of the agreement carefully. You can choose one of the investment programs offered by the insurer. Each insurance company chooses on its own what exactly will be included in the investment portfolio, usually creating several offers for different strategies. Aggressive, with the probability of greater income, but also greater risks. Conservative, in which the risks of losing money are lower, but the probable profit is also less. Example: Jack works in a government agency. He is regularly paid and in good standing with his superiors. He wants to earn extra money, but with minimal risk. The insurance company offered him an investment insurance program. Jack will make a profit if the situation in the stock market is favorable. By investing in investment insurance, you receive a tax deduction from the contribution. However, keep in mind that contributions and investment income are not insured, unlike bank deposits. If the insurance company goes bankrupt, you could lose all your money. Therefore, you need to be very responsible in choosing an insurer. Additional benefits of life insurance. Risk payouts are tax-free. Income tax on survival payments is levied only on the difference between the amount of the payment and the amount of contributions, minus the refinancing rate. Tax deduction. You can apply to the tax authorities with an application and return a tax deduction in the amount of insurance premiums paid for the tax period under voluntary life insurance contracts for a period of 5 years or longer. Targeting. Death insurance payments are not included in the inheritance. Only the person you specified will receive them. This is caring for the most vulnerable family members. You can protect, for example, grandchildren or children from a first marriage. Special status of the policy. Insurance policies are not property, so they cannot be levied by third parties. They cannot be confiscated, arrested, or, for example, divided during a divorce. Always read the insurance contract to the end. Carefully study the insurance rules, ask questions to the insurer. Understand what an insured event is in a particular contract. By terminating the agreement early, you risk losing some or all of the contributions, for example if you terminate the agreement in the first year of the term. Therefore, pay attention to the procedure for determining the amount of the redemption amount under your contract. Also pay attention to term of the insurance contract, amounts of insurance premiums, frequency of payment of contributions, distribution of the risk and accumulation part in insurance, list of exclusions from insurance, grounds for refusal to pay insurance, conditions for early termination of the contract. Do not hide information about your health if it turns out that you withheld important information. The insurance company may invalidate the contract and will not pay anything. What to look for when choosing an insurance company. Availability of the bank's license for life insurance. Experience of the company. Customer reviews. Tariff policy of the company.